Live financial markets are chaotic, high-velocity data streams where millions of variables collide and interact every single millisecond. To navigate this chaos, quantitative developers build algorithmic trading strategies, called alphas, and test their logic against historical market data, a process known as backtesting. When you run a simulation on a proposed alpha, the immediate output is a profit and loss graph. This graph plots the cumulative profits and losses over the entire simulated timeframe. Generating a profit is obviously the baseline requirement, but evaluating a strategy based solely on the raw return value at the end of the graph is highly deceptive. An alpha can easily produce massive backtested returns on screen while being mathematically uninvestable in a live trading environment. To accurately evaluate an alpha, we have to look past the top-line profit and balance those returns against the hidden operational realities of live markets. This means measuring the strategy across three distinct pillars. First, the returns, second, the risk, and third, the friction. We need to systematically synthesize these pillars into a single mathematical framework, an objective function, that accurately grades an alpha's actual odds of survival. Without a unified mathematical model to filter our results, developers are simply gambling on lucky simulations rather than engineering robust financial systems. Most backtesting environments, including the one we will use, evaluate strategies under the assumption of a long-short portfolio. Because the algorithm continuously takes both long and short positions, the total investment capital deployed practically equals half of the total book size. When we look at returns, we are strictly measuring the absolute profit generated on this specific restricted capital allocation. Raw returns, however, do not reveal the efficiency of the strategy. A high profit number does not dictate how hard that capital had to work to generate the gain. To see true capital efficiency, we must examine the strategy's margin. This animated diagram illustrates how margin is calculated by dividing the total P&L by the total traded amount over the backtest. Algorithmic margins are typically razor-thin. To measure them accurately, we abandon the standard percentage symbol in favor of a basis point. A basis point is exactly 1/10,000th of a percent. This unit reflects the extreme precision required when evaluating quantitative trading. If an algorithm relies on deploying massive amounts of capital to squeeze out tiny absolute gains, it exposes the entire strategy to systemic vulnerabilities like slippage and market impact. High top-line returns lose all value if the underlying margin is inefficient. Under real market pressures, an inefficient strategy will rapidly bleed capital dry. Capital efficiency only matters if you keep what you earn. This brings us to risk. Volatility is the primary enemy of compounding capital. To quantify a strategy's exposure, we look at its drawdown, a metric designed to measure the severity of the alpha's worst-case scenario. This chart plots an equity curve, specifically highlighting the drawdown, the absolute largest percentage loss incurred during any single year of the backtest. A viable alpha must target a return-to-drawdown ratio greater than 1. The profit must consistently exceed the maximum potential loss. Drawdown isolates the worst moments of the simulation, but we also require a metric to evaluate the day-to-day consistency of the profits being generated. For this, we use the Sharpe ratio, the industry standard for measuring risk-adjusted returns. This is the Sharpe ratio formula: average annualized returns divided by the annualized standard deviation of returns. The numerator normalizes the profit over a yearly timeframe, giving us a baseline of the strategy's expected yield. The denominator measures the standard deviation of those returns, acting as a strict mathematical penalty against volatile swings. To properly annualize, the equation scales the daily metric by multiplying by the square root of 250, accounting for active trading days. A higher Sharpe value directly indicates a mathematically superior and more reliable alpha. The Sharpe ratio proves whether an algorithm is generating deliberate, systematic profits or just riding a wave of volatile spikes. We now have metrics for return and risk, leaving the final constraint of live market trading, operational friction. An active alpha changes its positions daily. This requires capital to continuously move in and out of the market. We measure this capital velocity as turnover. Turnover is the percentage of the total capital the alpha trades on any given day. Here we see daily position changes plotted alongside the turnover formula. value traded divided by value held. The economic consequence of turnover is severe. Every position change incurs real transaction costs. As demonstrated, rising turnover automatically compresses the strategy's remaining margin. If a strategy enters and exits positions too frequently, it will literally trade away its own profits in fees and spread costs. An alpha boasting a massive Sharpe ratio is mathematically useless if its transaction costs consume the entire margin before the money clears. Minimizing capital velocity is just as critical to the viability of a quantitative strategy as maximizing its returns. An alpha cannot be considered viable unless its operational friction is strictly limited by the algorithm's internal design. Now we bring these three isolated pillars, returns, Sharpe, and turnover, together into a single evaluation tool. We call this synthesized metric fitness. It serves as the ultimate objective function used by the simulation engine to grade an alpha's total viability. This equation visualizes the exact calculation. Fitness equals the Sharpe ratio, multiplied by the square root of the absolute returns, divided by the maximum of either turnover or 0.125. The optimization dynamic of the numerator is straightforward. The developer must push to increase both the Sharpe ratio and the absolute returns. Conversely, the denominator forces the developer to relentlessly compress and reduce the strategy's turnover. The 0.125 constant built into the denominator acts as a mathematical floor.
This prevents the equation from breaking or returning infinite values if an alpha rarely trades. This formula creates an inherent mathematical tension. Tweaking an algorithm's logic to improve its raw returns almost always triggers adverse impacts, driving up turnover or degrading the Sharpe ratio. Even when backtesting simple logic, like a volume-weighted average price reversion strategy, the developer engages in a constant exercise of balancing these opposing forces. An isolated improvement in the profit and loss graph is functionally meaningless if the overall fitness score drops. Only a rising, unified fitness score can mathematically prove that your algorithmic adjustments are actually engineering a robust, live market-ready alpha.